tax relief. Sorry, I started too soon. Good afternoon and welcome to this Lincoln Institute webinar on residential property tax relief. I am Kim Rubin, the Saul Price Fellow and Director of the State and Local Finance Initiative at the Urban Brookings Tax Policy Center. Today we'll hear presentations by Joan Youngman and Adam Langley, the Director and Associate Director of Tax Policy Work at Lincoln, and Ron Rackow, a Lincoln Institute Fellow who for 25 years served as the Commissioner of Assessing for the City of Boston. Last year, Adam and Joan wrote a policy-focused report on residential property tax relief, an incredibly timely subject following the uncertainty of the last few years. While state and local governments were unsure what their revenues would be during the pandemic, most fared better than expected following the dramatic closing of workplaces in 2020. But questions remain about what comes next and what revenues will look like for local governments going forward. As we're experiencing high inflation and as house prices and rents continue to rise, there are calls for property tax relief. This report is a great tool for policymakers and really all of us to help understand what options exist and the ramifications of different policies. This report is available for free download on the Lincoln Institute website, and the URL should be in the chat. Looks like this. But first, some quick housekeeping. This virtual event is being recorded and will be posted online afterward. All participants are muted, but please type your questions or comments into the Q&A box at any time. We will be reviewing this throughout the panel and are leaving time at the end for the panelists to respond. And now Joan will begin our discussion.
Great, thank you, Kim. We're delighted to have the opportunity to share some perspectives with you about property tax relief for homeowners, which is the #1 most frequently searched topic on our property tax website. In our report, Adam and I looked at about a dozen different options for property tax relief and came up with a set of recommendations. And so today we'd like to share these with you and give you an overview of our approach. We start from the importance of the property tax as a revenue source, representing about half of all revenue raised directly by local governments. So we begin with the perspective that we want to preserve the strengths of the tax while addressing its challenges in fashioning relief. So a first important strength is its stability. Health, safety, education, the services of local government, they require a consistent and reliable revenue source. And the property tax can help balance more volatile sources like income or sales taxes, which tend to fall quite rapidly in downturns. Here you see 2 prior recessions, and especially interesting, the 2007-2009 recession, because that witnessed a historic drop, 30% in residential values all across the US, something not seen since the Great Depression of the 1930s. And even there, the property tax was able to have a stabilizing role. It's important to remember that state governments would be relying mostly on sales and income taxes. So a recession or a downturn is a time when state aid might not be as available right at a moment when there might be special service needs facing local governments. A very important benefit of a tax on immovable property is that the tax base is immovable. It's very hard for small local governments to put independent taxes on mobile revenue sources. And some independent source of revenue allows local governments to be responsive to the needs and choices of their citizens. Even in our state of Massachusetts, we are not large enough to avoid tax competition with our neighbor, New Hampshire, which has no general retail sales tax, and we lose sales at the border. Wage and income taxes can cause job loss, and we see that with the wage tax in Philadelphia. Another benefit of the tax, which is also a challenge, is its visibility and transparency. No one knows how much sales tax they pay over the course of a year, and very few people understand the federal income tax. But homeowners tend to be well informed about the value of their property. Transparency and accountability can lead to better decisions when taxpayers know what they're paying and what services they're receiving. But this also ensures that the property tax will never have a quiet life. It will always be controversial because it is not an invisible tax. Another important strength of the property tax is economic efficiency. You want to raise revenue with as little drag on local economic attributes as possible. If you put a income or sales tax on top of state and federal taxes, the combined rates can be high enough to cause taxpayer resistance and harm economic growth. This is an example of the result of a window tax. There was a window tax, for example, in Britain for more than 100 years. Windows were very expensive, so they were a good index of value. You could view them from the outside. You didn't have to do any interior inspections. But as a result, windows were boarded over or bricked up, and buildings were constructed with whole stories without any windows at all, with terrible effects for public health. So trying to do as little damage to economic activity as possible, the property tax exerts less drag on the economy than many alternatives. But the property tax has challenges to be faced, and any local tax faces the issue of fiscal disparities, where wealthier areas can raise more revenue, even with lower tax rates, than poorer areas. But this isn't a property tax issue, it's a local tax issue. Areas that cannot have enough resources on their own to provide quality services to their residents need assistance from a higher level of government. And here's where circuit breakers, which we'll discuss, or other state-funded relief measures can be of more assistance in addressing fiscal disparities, because they tend to direct more aid to the less wealthy areas. Liquidity is a challenge for any asset tax. We hear about this in relation to the estate tax, whenever there are recommendations for wealth taxes, when taxpayers have a mismatch between their cash flow and their asset values. Now, this can be a long-term situation. For example, if you have seniors in a large house after the family has moved out, now on a fixed income, or if you have families in gentrifying neighborhoods where the house price rises out of proportion to income. It can also be a short-term economic situation in relation to a setback, such as a temporary job loss. Tax deferral options are often a good result for senior citizens because they tend to have more equity in their houses, and that can serve as collateral for the loan of a deferred tax. Income-sensitive tax relief can help with others, non-seniors. The volatility of the tax can be a major challenge. Any kind of quick, unexpected change in tax bills is very problematic. Often, this is the result of long deferred revaluations. So the first line of defense is to keep values up to date. When new values come after a long period of no revaluations, it may be necessary to phase in the increase to avoid this kind of shock. But volatility is just one aspect of the larger challenge of accurate assessments. Unlike a sales or an income tax, a property tax depends on the government's estimate of the value of the taxable object. And so it's very important that assessors use statistical techniques, regular updating. And interestingly, this is an area where it's very important in times where values are rising rapidly to reduce tax rates, to keep revenues level. Often, local officials face long deferred service needs. When values go up, they want to take advantage of that. But if taxpayers associate revaluations with automatic increases in tax, they will resist revaluations, and then that will make the problem of inaccuracy much worse. So this brings us full circle because we talked about visibility being a benefit, and it's also a challenge. It's a strength. It brings accountability and transparency. It helps to produce better fiscal decisions, but that is not a reason to make things hard on taxpayers. One or two large bills every year can be a real difficulty for households that struggle to meet unexpected requirements of this type. So putting the property tax on a monthly option, allowing taxpayers to pay in the same manner as almost all other responsibilities of home ownership can be a great benefit. So that's the overview of what we brought to our consideration of different tax options. And you see that we have basically 5 recommendations: to implement quality assessment practices with regular revaluations, utilize well-designed state aid formulas, provide targeted, cost-effective property tax relief with circuit breakers and deferrals, allow homeowners the option to pay property taxes on a monthly basis, and to avoid tax limitations, especially assessment limits. So I can say a word about the first 2, and then Adam will discuss the others. Regular revaluations are so important because long periods without reassessment, where old values are carried on the books and not updated, mean that the rapidly growing areas increasing in value, often the most affluent, are being subsidized by the taxpayers whose property is stagnant or even declining, exactly the opposite of what you want. So quality assessment practices require regular revaluations, modern statistical techniques, state oversight, and effective appeal system, as well as keeping tax bills stable by adjusting tax rates. The state role is particularly interesting. For example, Pennsylvania is a state with almost no state oversight of local assessments. And a study back in 2007 found that 18 of their 67 counties had gone more than 20 years without a full revaluation. And then later in 2016, a study found that 15 of those counties were assessing property at less than 1/4 of its market value. So this is definitely a role where the state needs to encourage accurate assessment at the local level. But state aid is also very interesting in and of itself. We talked about how the problem of fiscal disparities that face any local tax require aid from a higher level of government. But actual cash transfers, revenue sharing, aid to the local government might not be the most effective approach if the goal is residential relief, because any local government will have service needs and unfunded projects, as some part of state aid can be expected to go to addressing those. And the part that is directed towards tax relief may be divided between residential and non-residential taxpayers. So if the goal is residential relief, state-funded residential relief is the best option. For example, about 1/3 of the states aid in funding the local homestead exemptions. So now I'll turn it over to Adam.
Thanks, Joan. So our third recommendation is to provide targeted and cost-effective property tax relief with circuit breakers and deferrals. So let me take a moment to explain how those programs work and why we recommend them over other types of relief programs. So first are circuit breakers. And the goal of these programs is to provide relief to prevent households from being overburdened by property taxes, just as an electrical circuit breaker is meant to prevent a circuit from being overloaded by electric current. So that's where the name comes from. And circuit breakers target property tax relief to households paying the highest share of their income in property taxes. seniors on fixed incomes, workers who lost their jobs, etc. And now the term circuit breaker is used to describe many different types of programs, but in our report, we use a more specific, precise definition. We define circuit breakers as programs that set a threshold percentage of income that property taxes must exceed before tax relief is available. And then the circuit breaker benefit offsets any property taxes above that level. So, for example, let's consider 5 hypothetical households. Before any tax relief, you can see that their property tax burdens vary widely. Home number 1 on the left-hand side is paying 2% of their income in property taxes, whereas home number 5 is paying 10%. But now let's say there's a 5% threshold circuit breaker. After the circuit breaker benefits are accounted for, nobody pays more than 5% of their income in property taxes. Property tax relief kicks in to offset any tax liability above that threshold. So, for example, home number 3, which had been paying 6% of their income in property taxes, now receives a circuit breaker credit that offsets 1 percentage point of that tax burden. So again, the purpose of circuit breakers is to target tax relief to households who face the heaviest property tax burdens. Another promising approach for property tax relief are deferrals. With these programs, homeowners can apply to defer payment of their property taxes until their home is sold or the owner dies. And at that point, the full amount of deferred taxes are due, typically with interest added. So deferrals directly address the liquidity problem faced by homeowners who are housing rich but income poor by allowing them to tap their home equity to pay their current property taxes. And these programs work similarly to reverse mortgages, except that they usually have lower interest rates and significantly lower fees. But it's important to note that eligibility for deferrals is typically restricted to low-income seniors. Now, I should note that there are several other options for providing property tax relief, and each of these approaches have merit. Homestead exemptions are the most common type of relief program. And these programs work by exempting a certain amount of assessed value from taxation, which in turn reduces the amount of taxes owed on a property. And most jurisdictions exempt a fixed dollar amount from taxation, which will provide relatively larger tax savings to lower valued properties and thus make the property tax distribution fairer and more progressive. So, for example, with a $20,000 exemption, a $100,000 home would get a 20% tax cut. A $200,000 home would get a 10% tax cut. A $400,000 home would receive a 5% tax cut, and so on. You can see that progressive impact. However, some states exempt a fixed percentage of value from taxation, such as a 20% exemption. But this approach is less common, and it really does not make the property tax distribution any fairer. Homestead credits are similar to exemptions, but they reduce tax bills directly rather than by reducing taxable values. So, for example, a state could provide a $200 property tax credit for all homeowners. And one advantage of a flat dollar tax credit, like a $200 credit, is that they provide relief without creating an incentive for higher tax and spending levels. And that's not the case for homestead exemptions and most other types of property tax relief. So it's one advantage of homestead credits. Income-based homestead credits tie the amount of relief to an applicant's incomes, with credits decreasing as incomes increase. So, for example, a state could provide a 75% property tax credit for households with incomes up to $10,000, 50% credit for those with household income of $10,000 to $20,000, and a 25% credit for incomes of $20,000 to $30,000. And by means testing benefits, these programs are more cost effective than programs that do not take income into account when determining the amount of relief. And then finally, a few jurisdictions provide credits to offset rapid growth in property taxes. So, for example, a state could provide a tax credit to offset any property tax increase above 10% from the prior year. And these credits are a good alternative to assessment limits, which I'm going to discuss shortly, because they really are meant to help homeowners facing particularly rapid growth in property taxes, but they do so in a way that avoids the unintended consequences of assessment limits, and also these programs are able to be targeted to needier households, which again is not the case with assessment limits. So there are many different types of relief programs. You may wonder why we specifically recommend circuit breakers and deferrals. And the main reason is cost effectiveness. But it's important to note that there is a trade-off between cost effectiveness on the one hand and the share of households that get relief. So first, homestead exemptions and credits, they're not very cost effective. And that's because usually all owner-occupied primary residences can get tax relief. And that universality can make them politically appealing, but it also means that these programs are very expensive. That might be a large budget expenditure, or it could be a large tax shift to other taxpayers. Yet, even with a generous homestead exemption, there will still be some people who struggle to afford their property tax. So, in other words, these programs are untargeted. They provide relief to some people who don't necessarily really need it, but insufficient relief to those who are most heavily burdened. Then we have income-based homestead credits, which are moderately cost-effective because they do target tax relief to lower income households. But for any given income, these programs still provide the same amount of property tax relief, whether tax bills are high or low. So again, there can still be some overburdened households, and you're still directing a large amount of money to people with relatively low tax burdens. So that's why we recommend circuit breakers. They're even more cost effective because they specifically target tax relief to homeowners with the heaviest tax burdens, those whose property taxes are highest relative to their income. With a well-designed circuit breaker, there should be very few, if any, homeowners who are really truly overburdened by property taxes. But because these benefits are targeted, the overall cost will usually still be lower than a broadly available homestead exemption. So again, it's very cost effective. And then finally, deferrals are definitely cost effective. They can provide very substantial tax relief, usually allowing homeowners to defer 100% of their tax bill, but with no long-term cost to other taxpayers. But at the same time, deferrals don't really cut taxes, they simply delay payment. So, and in addition, deferrals aren't enough on their own because they really only work for homeowners with considerable equity in their home. And in addition, most states limit these programs to seniors. So taking all these factors into consideration, I think that the best approach is to pair a deferral and a circuit breaker program. And this approach will provide property tax relief that is cost effective and adequate. And again, that's our third recommendation, to provide targeted property tax relief. Our fourth recommendation is to allow taxpayers to pay their property taxes on a monthly basis. Now, currently this is not the norm. While nearly half of homeowners do pay their property taxes as part of their monthly mortgage bill, about half pay their property taxes in just one or two large lump sum each year. And this is a problem. We know that there are many households who struggle to set money aside for large irregular expenses. So for example, the Federal Reserve did a survey and they found that 37% of Americans could not come up with even $400 for an emergency expense. But in contrast, the median property tax bill is nearly $2,600. So what that means is if homeowners have not saved in advance for their property taxes, very few will have the cash on hand to pay their property tax bill. But there's an easy solution to this problem, which is that governments can allow taxpayers to pay property taxes on a monthly basis. That large annual tax bill is just $215 when split into 12 monthly payments, so it's more manageable. And there are two existing models for monthly payments in the US. First are what are called prepayment programs, which allow taxpayers to apply monthly, and then their monthly payments accumulate in an escrow account managed by their local treasurer. They build up, and they're then used to pay off their annual or biannual tax bill. A second approach is used in Milwaukee, Wisconsin. In that city, there's no need to apply for the program. Everyone's tax bill that they get gives them the option to pay in full or to send in a monthly payment, and then they're automatically enrolled in the monthly installment plan. So our fifth and final recommendation is to avoid tax limits, especially assessment limits. Now, there are three basic types of tax limits which have very different impacts on taxpayers and local governments. First, rate limits typically set a cap on property tax rates for specific local governments. For example, in Arkansas, the tax rate for municipalities cannot exceed 50 mils. That's equivalent to 0.5 percentage point of the home's market value. In some cases, states may cap the overall property tax rate for all local governments or freeze local tax rates as of a certain date. The second type of tax limit are assessment limits, which set a cap on annual growth in the assessed value of individual properties. For example, California's Proposition 13 caps annual growth in the assessed values of properties to 2% or the rate of inflation, whichever is lower. And then the third approach are levy limits, which cap overall property tax revenues in a jurisdiction, overall growth in revenues, I should say. So for example, Proposition 2.5 in Massachusetts restricts allowable growth in property tax revenues to 2.5% per year, with adjustments for new construction. Now, of course, in practice, many states use multiple limits and they add a variety of exceptions and other complexities. But again, the most important difference between these different types of tax limits is whether they cap rates, assessed values, or tax levies. Now, certainly we understand the desire to constrain property taxes and to promote fiscal discipline, but tax limits are generally a poor way to achieve those goals. One fundamental problem is that tax limits are inflexible and they reduce local autonomy. They impose a one-size-fits-all limit on very different local governments. And so a single statewide limit reduces local government's ability to respond to changing circumstances and to reflect the unique preferences of the taxpayers in their jurisdiction. In addition, a single statewide limit may have no effect at all in wealthier areas while severely constraining declining communities, so it can have some inequitable effects. Research also shows that many property tax limits change the revenue mix for local governments, reducing reliance on the property tax, which is generally a stable revenue source, and increasing reliance on less reliable revenue sources. And there's also evidence that more restrictive tax limits can erode the quality of public services. Most studies have looked at the impact of tax limits on school quality and have generally found tax limits to be associated with lower test scores. And finally, it's important to note that assessment limits have particularly severe unintended consequences. So I'll take a few moments to discuss those in more detail. First of all, assessment limits shift the tax burden towards poor neighborhoods while decreasing the tax burden on wealthier, rapidly appreciating neighborhoods. So, for example, this map shows the impact of New York City's assessment limit, and it has significantly shifted the tax burden towards lower income neighborhoods with slower housing appreciation. Those dark red colors in the map in Staten Island and the Bronx, those areas have significantly higher effective tax rates than are seen in Manhattan and wealthier parts of Brooklyn. Another consequence is that assessment limits can create large disparities in tax bills for owners of similar properties. It's not uncommon to see a homeowner paying 2, 3, even 5 times more than a neighbor with a practically identical home. So, for example, I analyzed data for 5 random blocks in Los Angeles, and the data shows that the effective property tax rate exceeded 0.8% for 20 homes, but was less than 0.2% for 7 homes. So those 20 homeowners are paying more than 4 times more than their neighbors, again, within a very small area of Los Angeles. And that illustrates the large horizontal inequities created under assessment limits. You have longtime homeowners who often purchased property when it was more affordable, subsidized by those who buy their homes more recently, often at a higher purchase price. And then finally, assessment limits can produce a lock-in effect that discourages owners from moving simply to preserve their below market assessment. So you have empty nesters in homes that are bigger than they need. You have growing families squeezed into small homes, and the limited supply of starter homes can make it daunting for younger homeowners or younger households to become homeowners at all. So again, there's a lot of research showing the downsides of tax limits. But there is an alternative approach that can effectively constrain property taxes without those unintended consequences. Truth in taxation measures, also called full disclosure, generally require that any increases in property tax revenues due to higher values are subject to the same procedures as required for an increase in the property tax rate under state law. So that can be public hearings, a vote by the city council, mailings sent to taxpayers, explain the impact on their individual tax bill, etc. And if local governments do not wish to go through that process, which can be politically painful, then the tax rate is automatically adjusted downward to bring in the same amount of revenue as the prior year. So truth in taxation is meant to avoid the silent tax increases that can occur if elected officials fail to reduce property tax rates when property values are growing rapidly. So these laws constrain property taxes through transparency and by facilitating responsive rate setting, but they do not impose a binding constraint on all local governments. And research shows that these laws can reduce growth in property taxes in areas with rising home values. They do have an impact. So to recap, we need to remember that the property tax has some really important strengths as a local revenue source. It's a stable revenue source over the business cycle. Its immobile tax base allows voters more freedom to choose a set of taxes and services aligned with their preferences. It's also a particularly transparent tax, which promotes accountability for government's fiscal decisions, and it's the most efficient tax. But of course, like any tax, the property tax has its challenges. Fortunately, there are policy options to address all of those challenges. The key really is to design relief programs carefully to address specific challenges in your state while avoiding overly broad, untargeted measures that can undermine the strengths of the property tax while creating new, more severe unintended consequences. And our research yielded 5 key recommendations to promote an equitable and efficient tax system. The first is to implement quality assessment practices with regular revaluations. Accurate assessed values are the foundation of a fair property tax system. Without them, property taxes will inevitably be distributed in an unfair and arbitrary way. Effective state aid is also critical because that's the only way to address fiscal disparities between communities and to ensure that all jurisdictions can provide quality services at affordable tax rates. Our third recommendation is to provide targeted and cost-effective property tax relief with circuit breakers and deferrals. And as a reminder, circuit breakers provide relief when property taxes exceed a threshold percentage of income, and deferrals allow homeowners to delay payment of their tax until their home is sold or inherited. Fourth recommendation is to allow homeowners to pay their property taxes on a monthly basis instead of just 1 or 2 large payments each year. And our final recommendation is to avoid tax limits, especially assessment limits. Again, tax limits impede local government's abilities to respond to changing circumstances and taxpayers' preferences, and they can erode the quality of local. Assessment limits can have particularly poor results, creating large disparities in tax bills for owners of similar properties, shifting the tax burden towards poorer neighborhoods, and producing a lock-in effect that discourages people from moving. A better approach to constrain property taxes is to use truth in taxation, to constrain property taxes through transparency and responsive rate setting, rather than a binding constraint in local governments. So again, the property tax has major strengths as a local revenue source, but it has its challenges. The good news is that there are proven options used by states around the country to address all of those challenges. And when they're used together, they can promote a tax system that is fair and affordable for taxpayers while providing the revenue needed for quality public service. So if you'd like to learn more about the policies we discussed today, as well as some other options that we did not have time to go into detail on, please check our recent report on property tax relief for homeowners. There's a link to it in the chat. And thank you for your attention. I'm going to turn it over to Ron Rackow to discuss efforts to provide property tax relief in Boston.
Thanks, Adam. So we're going to switch gears a little bit and talk a little bit about the Massachusetts experience with property tax reform. You know, unfortunately, property tax reform isn't always designed in a laboratory, and sometimes the political process doesn't always result in what one would consider to be best practice. But I think what we'll show is the Massachusetts experience with property tax reform over several decades. While it's not perfect, it avoids some of the pitfalls that both Joan and Adam had talked about in their presentations. So as Adam actually just mentioned, market value is really probably the most important element of the Massachusetts story and is very important to the whole reform effort. Massachusetts had a history of underassessing residential properties and overassessing business properties, despite a constitutional mandate for proportional taxation. There were a series of court decisions in the 1960s and 1970s that led to a reform effort that had both statutory components and regulatory components from the state Department of Revenue that really resulted in a strong adherence to market values that still exists today. And it's an effort that has grown over several decades and has really resulted in, I think, really good assessment practices. The second element of the Massachusetts tax reform effort is the fact that Massachusetts was able to maintain the local control, which we all believe is a strength of the property tax, the ability for taxpayers to control their spending and their taxes at the local level through their local government. But in Massachusetts, part of the reform effort was to put a strong state regulatory and assistance component in to ensure that the market value standards were adhered to. As I mentioned, we did have those court decisions in the 1970s, so it was really time to have more regulation. And I think Massachusetts has demonstrated both the regulation with the technical assistance from the DOR led and eased the path for communities to reach their market value standards. Another thing that happened in Massachusetts in the early 1980s is we did have our own property tax limit called Proposition 2.5. And it came in in the early 1980s at about the same time as the market value standards. And while assessment limits and property tax limits aren't necessarily a best practice, in Massachusetts, I think we were fortunate in that our Proposition 2.5 limits and regulates levies and tax rates, but not assessments. So there are no assessment caps or Proposition 13 style limits that distort market value. So we're able to still adhere to our market value standards while putting some controls on the growth of property tax levies through Proposition 2.5. And finally, the last thing in the Massachusetts reform effort that I think was important, and again, it's not necessarily a best practice, but in order to ease the political transition to full market value, there was some need to preserve the residential preference that was historically given in the valuation process. So Massachusetts was able to do that through a classification system. But again, it was done through the rate structure and not the valuation structure. And it's also done via local option under statutory limits. So we were able to preserve that residential preference within limits, but we did so with rates. So again, we were able to keep the market value standards pure. And I think that was very important to the efforts. What I want to do next is talk a little bit about homestead exemptions. Now, Massachusetts also has circuit breaker programs and tax deferral programs that are used, and those are I think the preferred targeted procedures for providing tax relief, as Joan and Adam have both mentioned. But recently, there has been some academic papers out there that have been talking about potential regressivity in assessments across the United States, where lower priced properties may be assessed at a higher percentage of market value than higher priced properties. And that's of great concern to a lot of policymakers. And one of the tools that policymakers have available to avoid this type of issue is a homestead exemption. So I wanted to share a little bit of experience with homestead exemptions in Boston and in Massachusetts and how they work and how we've been able to address this potential issue. So a homestead exemption is only available to taxpayers who own and occupy their homes as their principal residence. The exemption program in Massachusetts is a fixed dollar amount. It's set at a percentage of the average assessed value for all residential properties. So it's important that it's a fixed dollar amount because a fixed dollar exemption provides much greater benefit to lower price properties than higher price properties. And we'll show that in a little bit more detail in a few minutes. It's a local option to implement, so communities can choose the exemption percentage up to a maximum amount described by law. I provided a brief history of the exemption limits. As you can see, they've increased over time from 10%, a maximum of 10% in 1983 to a maximum of 35% today. The implementation is revenue neutral for the community, which I think is a unique feature of the homestead exemption in Massachusetts. So in other words, the tax rate is increased to compensate for the exemption amount. So it does not result in any less revenue for the local governments. And also important is that the exemption, the homestead exemption in Massachusetts redistributes the burden only within the residential property class within the classification system. So it has no impact on business properties. So here is an example of how the homestead exemption works in Boston using some data from fiscal year 17. So you'll see that the average residential value in Boston in fiscal 17 was $656,000. So the table below just shows what the exemption, the fixed dollar exemption amount would be at the various percentages. And you'll notice that as the percentages go up, the tax savings also go up. But you'll also see that the tax rate also has to go up to compensate. So that's how that revenue neutral component works. The higher exemption, the more the rate has to go up to compensate. And what this chart demonstrates is the effective tax rate based on those different exemption amounts. So you'll see that the yellow line, which is the 35% exemption, results in a very progressive distribution where the effective tax rate for the lowest price properties is in the 0.2% area, and it goes up steadily up until you get to about $1,200,000. And at that point, those properties actually pay more, even if they are receiving the exemption, than they would if there were no exemption. So again, the effective tax rate rises with property value with the exemption, and you can really kind of choose the level of progressivity that you want to introduce by increasing or decreasing the exemption amount. But as you can see, even a 10% exemption has a fairly significant impact on the progressivity in assessments. So again, the exemption does become more progressive for homeowners as the exemption percentage increases. And the good news is that properties that are owner occupied and are low and moderate value benefit more from the exemption and pay less in taxes. Rental properties, second homes, and higher value properties end up paying more with the homestead exemption. So there is a potential negative impact with a homestead exemption, particularly on renters who may live in properties with higher tax bills, and that may result in higher rent to the extent that the landlord does pass those taxes on to their tenants. But I think the one thing that we need to keep in mind is if there is in fact an issue with regressivity in the assessment properties, and lower value properties do present some unique valuation challenge that maybe is inherent in real estate markets, a properly structured and targeted residential exemption program can really address that imbalance and result in a property tax that is progressive, and even highly so in Massachusetts case. And I will also mention that for those of you who would like to have a little bit more information on our experience in Massachusetts, Lincoln does have a 3-part online course on the Massachusetts experience. There's a link to that course in the chat. So if you're interested in learning more about the experience in Massachusetts, I'd urge you to give that a try. And with that, I think we'll turn it back to Kim.
Thank you. And thanks all for joining us. And that was super interesting. And we have lots of questions. So I'm going to jump right into it. I'm going to try and combine some of them. We actually have 25 questions that have been super interesting to look at, and try and get through as many as possible. People will see your questions afterward, and I'm going to try and combine some topics. And so if I do some damage to your question, I apologize in advance. So first to start, can we talk a little bit about circuit breaker tax relief and whether places like Texas or other places without an income tax can actually implement a circuit breaker, and how would they do that? And what are the difficulties in doing that?
Sure, I'd be happy to answer that question. So there are states without statewide income taxes that have property tax circuit breaker programs. New Hampshire is one example that comes to mind. In some respects, it is administratively easiest to administer a circuit breaker as an income tax credit, a state income tax credit, I should say. But many places administer circuit breaker benefits by direct property tax credit on the tax bill. So the property tax bill goes out already accounting for the circuit breaker benefit, which is the best approach anyhow, since it doesn't create this delay between when you pay your property tax bill and when you receive the credit. And then documenting income, you could probably, I would assume, just do that with a federal income tax return. So in any case, it might be a little bit more difficult to administer a circuit breaker in a state without a state income tax, but it's not overwhelmingly challenging at all, and it is done by many states.
Great, thank you. And so we also got some questions talking about renters. Ron covered this a little bit at the end, but if you think about sort of differences across income and sort of what does it mean if homestead exemptions or property tax relief is targeted to home ownership, if we think that lower income folks are more likely to live in rental housing? Is there a way that we can get some relief to them? Or how does rental property fit into this all as we're thinking about ways of making housing more affordable?
I can take that question. So again, returning to circuit breakers, many circuit breaker programs do include renters, and they calculate benefits by assuming that a certain percentage of rent is equivalent to property tax. So if your annual rent is $10,000 and you assume that property tax is 25% of your rent, which is about normal for these programs, then you'd be assuming that that renter is paying around $2,500 in property taxes, and then you just use the same formula used for homeowners. And then secondly, there are programs that you can just offer tax credits for renters, or other programs kind of outside of the property tax relief program, to make sure that renters are not being kind of disadvantaged by the creation of a property tax relief program.
Right. And that's something we do in DC where I live, which is actually an incredibly progressive way of getting money to renters, is through the income tax system where they get to take some tax relief.
I would just add that it's important to think about rental property in terms of the whole larger property tax system, that if there are certain categories of residential property that don't include rent, it's very difficult to make it a progressive system. In New York City, the effective property tax rate on rental property is 3.5 times that on homestead property. And that's just the opposite of what you'd like to see in terms of where the more affluent people with the better ability to pay are.
Okay, great. And what would you recommend in terms of property tax relief for a place like Cleveland, Ohio? This is coming from Ed Stockhausen, where the homestead exemption is insufficient for eligible seniors, disabled homeowners, and not available to many households. Circuit breakers are hard to implement because it doesn't fit into the way the county auditor's offices work. And property tax deferrals aren't necessarily going to be that helpful if house values haven't necessarily appreciated over time. Have you thought a little bit about what systems might work better in a place that has seen large increases in residential property versus those that have more stagnant or maybe more vacant housing?
I'm happy to. Do you want to go, Joan?
Well, I can just start because there's so much to say about this, and part of it is putting it in the perspective of there are places that require aid from higher levels of government. That if your local resources are not sufficient for quality public services at affordable rates, that is where you're facing fiscal disparities that need outside assistance. But I would also say that circuit breakers might be difficult because they don't fit in with the way the assessors have traditionally worked. That's always an administrative challenge. And for example, instituting a monthly property tax option could be very different from the way the assessor's office has worked in the past. But seeing that it does work in some places in affordable ways can open up opportunities to try something new.
Thanks. And can you say something about how something like the monthly payments you were talking about differ from something like an escrow account, where people are basically paying it as part of their mortgage, and what share of people are doing each of these types of things, and why can't we just have people do it through escrow?
I can take that question. So, yes, so by far the most common approach to allowing monthly payments are these so-called prepayment programs, where the tax collector essentially runs an escrow account similar to a mortgage, a bank that is offering a mortgage. But a lot of people don't have mortgages, particularly seniors. And so those are the people who have the greatest need. I mean, there are places with monthly prepayment programs that one of the eligibility criteria is that you're not eligible for a mortgage escrow. So it's filling a gap, a large gap in the public. There are also people who do have mortgages, but their lender does not escrow property taxes. It can be very complicated in some places where you have, 7 different taxing districts, and banks, particularly small banks, just out, we don't want to deal with this. So in terms of the take-up rate, it's relatively low. The prepayment programs where people apply, I would say 5% of taxpayers would be a pretty high participation rate. In Milwaukee, where the tax bill just allows people to just send in a first monthly payment, and so there's no application process, their take-up rate amongst people without mortgages is more like a third. So it's far higher, and it really shows the impact of just these slight, seemingly modest administrative differences that can make a huge difference in the program's effects.
Thank you. And we've gotten a few questions about generational wealth and also disparities across different groups of different racial groups or people who are higher or lower in terms of income. So would something like a deferral program impact sort of the way that we largely see people passing on wealth to the next generation? And is that a bad thing, that you might be basically disrupting the dissemination of generational wealth, especially for lower income or Black and brown families who don't have much other areas of saving or capital? And also getting back to something that we covered a little bit in Boston, but this whole idea of whether assessments vary by race and whether we actually see different groups negatively impacted by differential assessments across different places based on, and some of the work done on zip code data. Can any of you talk about, like, is there a problem with deferral of property taxes in terms of what it means for the next generation?
Well, I can start on that because it's a big issue, and many deferral programs are vastly underutilized because there is a totally human and natural desire to pass on property to the next generation free and clear. That is completely legitimate. The addition of a deferral option actually changes some of the public debate, because as you know, there's a lot of anti-tax sentiment, and the nuclear option is to say that elderly homeowners are going to be forced out of their homes, or they're going to have to choose between the necessities of life and paying their tax bill. And this is used as a reason to have a general across the board reduction in tax, anti-tax. Having a deferral option changes that debate. There still are very important aspects of being able to pass on wealth. And there may be other ways, if it's low income, if it's eligible for a different kind of relief. But I would say it's not a blanket overall. We should not ever have a lien on property, never have a way to use that property to pay bills. That is an important option to have, even though it's not going to address every issue.
Just one thing I would add on the generational inequity is that, yes, a property tax deferral would reduce the amount of inheritance to an heir, but if that allows a senior to stay in their home 10 years longer than they otherwise would have, it actually could promote generational equity. So I don't think you can say anything definitively about how those programs would affect that issue.
All right. And
Yeah, just quickly adding on that, I mean, where we see a lot of appreciation in gentrifying areas, that's where I think deferral can be the most useful. And if that means that somebody can stay in that house a little bit longer so that they can then pass it on to their heirs, that's where I think deferral can actually be a good tool, and especially a good tool for that type of use.
great. I want to switch gears a little bit and try and get one more question in. So can we think a little bit about how circumstances have changed, and sort of, if we think about post-pandemic, what does it mean in terms of what we're seeing in the commercial property market, in terms of there might be empty buildings and that might lower the amount of taxes being paid by businesses? Is that going to shift it onto homeowners? And what does that mean in terms of pressure for tax relief for residential property? And can we say anything about what Boston's experiencing as people aren't necessarily returning to the central commercial district or something?
Well, not only for Boston, but for urban areas in general, I think this is going to be a coming concern, because the property tax looks back in time. So a lot of the valuation trends that happened as the result of the pandemic are really now just starting to find their way into tax bases. And in urban areas, you see commercial and business properties paying a large portion of the property tax levy often. So to the extent that hotels and office occupancy rates aren't returning to their levels, rents are depressed, that does mean that the value of properties in that sector could be stagnant or declining at a time where we've seen such significant increases in residential properties. So I think that there is a risk that there might be a shifting of the tax burden. Either communities are going to have to reduce their tax levies, or they're going to have to shift some of that burden onto the residential taxpayers. And I think that's where some of these targeted tools for providing tax relief, like circuit breakers, are just going to be so important, because we're going to want to preserve government revenue to fund services, but at the same time, provide the necessary relief.
Thank you. And we're just about out of time. I'm sorry to those of you who asked great questions that I didn't get to as we went forward. We're hoping you'll join us at other events. Some of the stuff I didn't get to are questions about split roll and whether it would be fairer to tax land only or improvements differently. There's more information about this on the Lincoln Institute website, which is part of the reason for its existence. And so with that, I'm going to bid you goodbye and hope you join us soon for other events as they come up in the future. And thank you to all of our participants for both producing these reports and giving us such a great walk through them.